This is episode 22 of EO Radio Show. In this episode, my law partner Hans Young and I finish our conversation about the first season of the Apple TV Plus series Loot, starring Maya Rudolph. As in last week's episode, number 21, we look at some technical legal topics, and then we have some fun imagining being the lawyer for Molly Wells. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So welcome back, Hans. Thanks for joining us.
Thanks for having me back.
So you want to recap the characters, and I don't want to go over too much of the series synopsis a second time, but orient the listeners who may not have already heard part one of this episode.
The characters, as a quick recap, we have Molly Wells, who's played by Maya Rudolph. She's the main character. We have the Wells Foundation, which is the foundation, the charitable foundation that Molly created and funded at one point, but for many years forgot about and has rediscovered as a result of her divorce. And then there are a number of characters that are within the foundation itself. We've got Sophia, the foundation director, who runs things at the foundation. We have Howard, Molly's distant cousin, and I believe he plays the IT specialist at the foundation. There's Arthur, the foundation accountant. And as we mentioned, there's there's Nicholas, who's Molly's personal assistant, as well as there's a couple recurring cameos. There's one by Seal, the recording artist. There's celebrity chef David Chang, who actually, pretty funny, plays himself, but is Molly's personal chef. And I think actually makes repeated apologies for letting his restaurant empire take him away from his services as her personal chef.
And that's part of the setting, I think. Some of the food plays a very important part in many of the plots. They eat quite well in the show. It's set in Los Angeles. Many scenes are at a very, very lavish house there. So it's pretty over the top. So I think we were going to go back to some self-dealing topics.
Where we left off in part one, you had just defined self-dealing and given some examples of that. Could you remind us what that is?
Yeah. So self-dealing is a really important concept in charitable law. The term self-dealing derives from an Internal Revenue Code provision that has a dramatic penalty on people involved with private foundations. The basic rule provides that any direct or indirect transaction between a private foundation and a disqualified person can result in really heavy self-dealing penalty taxes that are imposed on the foundation managers and the disqualified persons. So the specific transactions that are subject to these self-dealing penalties include sale, exchange, or leasing of property, lending money or extending credit, furnishing of goods, services, or facilities, payment of compensation. And we covered the comp issue quite a bit in the first part of this series in our discussion of Howard and his role as the IT guy. And also self-dealing includes a very broad catch-all situation where there's a transfer to or use by or for the benefit of a disqualified person of the income or assets of the private foundation. And we talked about some of the exceptions to compensation, but that's the basic framework for self-dealing that can be subject to these very hefty penalties.
In part one, we talked about how Molly comes to find out that as part of the marital settlement, some of the assets that she received included a theme park or perhaps many theme parks, some in the Philippines, an alpaca ranch, an art gallery. And Molly finding out that she owns all these assets prompts her to want to find more information about what she actually owns and get her arms around it. Because at this point, as I think the show has made very clear, she had spent most of her life up until that point enjoying her lavish lifestyle. I don't think she was spending a lot of time figuring out what she owned and how it all operated. So she has Arthur, who is the foundation accountant, do a pretty extensive review of her personal assets and her portfolio. Is that allowed under self-dealing? Because it would seem as though that might skirt the line. He's a foundation employee and he's being asked to then analyze Molly's personal portfolio, not the portfolio of the foundation. At least that's what it seems to be.
Yeah, I think that was a pretty clear part of the plot. He says something to the effect of, because she invites him to go on a trip to actually do site visits of these various businesses that she owns. And he says, well, I can't leave my office in the middle of the day, can I? And Molly says, well, I'm your boss, aren't I? So of course you can. I tell you what to do. So that's probably the first point in the series where I stopped and I was like, it doesn't, I think they got something wrong here. This is a good spot to pause and talk about these prohibited self-dealing transactions and the last catch-all that I mentioned. That is the transfer to or use by or for the benefit of a disqualified person of the income or assets of the private foundation. So using foundation office space or office staff for the private benefit of a disqualified person could indeed be a self-dealing transaction that's penalized by the code. So here, Arthur's not an asset of the foundation. His time and his job obligations are an asset of the foundation. And so for Molly to use Arthur for her own personal investment analysis, that's not allowed. That would be a self-dealing transaction. One might make the argument that in doing this, Arthur is really helping Molly understand how the assets she holds affect the public standing of the foundation. They don't make that point in this plot, in the plot line that, oh my gosh, look how bad it looks for the foundation that Molly owns this. There are some, I'm digressing a little bit. There are some points where Sophia says to Molly, you need to behave because your behavior affects us. But here for self-dealing purposes, we're talking about whether her assets, whether Arthur's investigation of her assets is a misuse by Molly of his time. I suppose there is a little bit of a character that if there's something bad going on at the art gallery, that would cast a negative light on Molly and the foundation. I didn't really buy that. I thought this was more about investigating her assets so that she could understand what they were for her own personal purposes.
And I think it served the secondary plot point of, I don't know if we mentioned the spoiler alert for part two, but I think it drives, we come to find out Arthur has feelings for Molly.
Right.
It's as a result of this retreat or the site visits that he starts bonding with her. So I think it served that plot point too, to have this happen.
Right.
And have his involvement.
Yes. And maybe in season 2, we'll get more clarity on that. But for now, if we go too much into the Arthur-Molly relationship, we'll have to get an employment lawyer on the line. But
that's right.
But back to the self-dealing rules, I thought this was a really good point to emphasize how draconian the penalty taxes are. When there's a violation of the self-dealing rules, there's a penalty tax of 10% of the amount involved. And amount involved is a defined term for these purposes. So it's a 10% tax of the amount involved for each year in the period, taxable period, which is the time frame over which this improper use is not corrected. So that's 10% of the amount involved each year. And then there's an additional 5% of the amount involved that's imposed on the foundation managers. So the 10% tax is imposed on Molly as the disqualified person who's using Arthur, and 5% is imposed on the foundation manager that approved it. So potentially Sophia, but not Arthur. Arthur didn't do anything wrong here, and not Wells Foundation. So for example, let's just say Arthur's salary and his overhead is, let's just say $2,500 a day. Then the penalty on Molly would be 10% of the cost that she's misusing. $250 for each day that he works on her personal work. And then Sophia pays 5%. So her penalty would be $125 each day that Arthur works for Molly. And then this penalty applies again every year until that act is corrected. So sometimes foundations go for at least a few years before their accountants and other, it's typically accountants that find these sorts of problems. But sometimes it can go for quite a few years before it's discovered, and the penalty keeps repeating itself over and over again. The penalty continues to accrue until Molly pays back the foundation for her inappropriate use of the foundation assets. So she needs to pay back the foundation $2,500 a day for Arthur's time. So in the grand scheme of the Wells Foundation, maybe Molly doesn't care. The reason why the foundation cares, though, is that this is a self-reported penalty, and it ends up on the foundation's tax return, which is a public document. And for a high profile organization like Wells Foundation, you can be sure that the media are scrutinizing the tax return and they'll pick up on a self-dealing transaction pretty readily. And definitely something that a foundation wants to avoid.
And so let's just say Molly refuses to correct the self-dealing because maybe she thinks it's not a big deal. She does not pay the foundation Arthur's compensation. Are there other penalties or what's the consequence there?
Because the IRS is well aware that very high net worth people sometimes don't care all that much, the draconian second level penalty is actually 200% of the amount involved. So instead of it being a 10% tax per day, it's 200% each day. So it's double the amount that has been inappropriately taken. So here in my example, if the first level tax was $250 a day for a $2,500 self-dealing transaction, the second level tax is going to be $5,000 per day of inappropriate use of Arthur's time until it's corrected.
And that's in addition to the first level tax.
Right. On these numbers, it's not all that dramatic, but in a self-dealing transaction where you're using office space as an example, and that's another point. Yeah, I think I mentioned that, but using foundation office for personal purposes can add up these penalties even faster than salaries.
Right. And we see almost immediately after Molly gets involved in the foundation, she gets her own office and quite a sizable one too. And so what you're saying is that would not be okay, or would that be okay? The fact that she's now using this office, presumably, at least from what we see in the show, it seems to be foundation related purposes. But I think it crosses that line here and there.
Yeah. It's not clear from the show whether Molly owns the office building and lets the foundation use it, or whether the foundation purchased this lavish, it's pretty nice office space. If it's foundation-owned office space, then Molly can't use that office for personal purposes. In many cases, the founder actually owns the building and lets the foundation use it. Providing rent-free space is not prohibited, but the flip side is prohibited. If that's a foundation office building, all Molly can use her office for is foundation business. She shouldn't be using those resources to manage her own assets. And we talked about this a lot in the context of Arthur. She has to be very careful about not using foundation office space for her own personal business.
That makes sense. At the start of the season, we learned that the foundation has $87 million. And by the end of the series, again, spoiler alert, it now has $120 billion because Molly has decided to give all of her wealth away. And so it increases by quite a bit, very dramatically. Are foundations, aren't they required to give away a certain portion of their assets, or can they just hold all of these assets, especially in a situation where now these assets have grown quite significantly?
Yeah, that's exactly right. It's not talked about in the popular press a lot, but there is a minimum distribution that private foundations are supposed to spend each year. And there's a lot of exceptions to it. But the general rule is that a private foundation is required to make qualifying distributions, and that's a term of art we'll come back to in a minute. Required to make qualifying distributions based on the average amount of investment assets that it held at the end of the preceding tax year. And so these distributions have to be made to qualifying distributees, qualifying charities, typically. So in very general terms, if a private foundation has a December 31 tax year end, and it held investment assets of $87 million for the entire year. So let's just say in 2020, Wells Foundation actually had $87 million in assets. It's only 10% of her wealth. But anyway, if a foundation had $87 million for the entire year of 2020, then the foundation would have to make qualifying distributions of just $4,350,000 by the end of the following December. So that's 5% of $87 million, $4,350,000 is what what the foundation would have to distribute. If it doesn't make those minimum qualifying distributions, it pays a penalty tax of 30% of the undistributed income. So I realized I was playing with the numbers a little bit there, but the $87 billion, it's not clear whether that's the foundation's wealth or Molly's wealth. In my little math example here, I was saying maybe she only put in 10% of that wealth. No, that's not 10%. 87 million, whatever fraction that is of 87 billion. It's a much smaller number.
Yeah. And you mentioned qualifying distribution. It's got to be at least 5%. What qualifying distribution says obviously implies that there's something that's non-qualified. What is a qualifying distribution?
Sure. Let's drill down into that. A qualifying distribution is any amount that's paid to accomplish religious, charitable, scientific, literary, or other public purposes. It doesn't include a contribution to an organization controlled by the foundation or by one of its disqualified persons or to certain other kinds of foundations. It has to be paid to, generally speaking, a public charity or an operating foundation. And this can include program-related investments. That's probably a topic for another episode, but foundations can sometimes invest in enterprises that have a public purpose, and that will count as a qualifying distribution as well. A couple of other things that qualify: amounts paid to buy an asset that's used or held for use directly to carry out the charitable or public purpose. So, for example, a private foundation might buy a museum building, a building where they're going to display the artwork, spending that money on the building to display the artwork. That would be a qualifying distribution. And they could set aside, suppose you're going to plan a very large building purchase. And so the foundation might set aside its 5% earnings each year for a few years in order to amass enough capital to actually acquire an asset for use in the charitable purpose.
I also wanted to ask, as we were watching, in the episode where they take the bonding, or they take the retreat to Miami, Molly comes back, and the plot point is that she realizes she was not prioritizing the foundation or its staff, and kind of has an aha moment that she needs to connect with her fellow staff members. And so she comes back home from Miami and shows up with Sophia and supports her at a council meeting. And it's about, I think it was they call it the Alameda Street Housing Project, and they're appearing before a city council. It's pretty strongly implied that her presence there helped Sophia accomplish the objective they wanted in that meeting. This sounds like it's lobbying, and it sounds like is this allowed, that a foundation, especially its founder and donor, would be able to lobby like this or swing a decision for the foundation? Yes,
that's a really good question. And this twist in the plot adds a really good point to talk about the lobbying and candidate electioneering issues. There's two really important rules. I'm sure Sophia is aware of them. I'm not sure Molly was in these parts. Private foundations cannot spend any amount of money on legislative lobbying. Lobbying is a very specific term when used in terms of in the context of the Internal Revenue Code. And that is any expenditure to influence legislation or carry on propaganda. For these purposes, legislation means any action by an elected body or by the public in a referendum, ballot initiative, voting on a constitutional amendment, or a similar procedure. So the key things there is you have to have legislation, that is written law, that is capable of being enacted by an elected body. So it has to be legislation. Administrative rules and procedures is not legislation. So that's an important exception. I'll come back to that in a second. Lobbying also doesn't include technical assistance to a legislative body. It doesn't cover nonpartisan analysis, study, or research, and it doesn't cover communications that are self-defense of the organization. So here, the city council meetings, it wasn't clear to me whether those were conversations about permitting a development or if it was a change to the law. If the city council needed to change a law, then a communication with the city council could be legislative lobbying for the foundation to do it. Molly, in her private capacity, can do whatever she wants. And so presumably, if she's not there being paid a salary, even if what the city council is doing qualifies as taking action on a piece of legislation, Molly can support it. But Sophia and the staff wouldn't be allowed to appear before the legislative body and take a position on the legislation itself. So I can't thank you enough, Hans. This has been a lot of fun. I want to give you a few minutes, though, to ask any final questions you might have or any thoughts on plot points or this series altogether as we wait for season 2 of Luke to come out.
Right.
What should we think about? Any final questions?
Yeah, I've got this question. I'm going to see what you think. If you are Molly's attorney, and I suppose it could be Molly's personal attorney or attorney for the foundation, what's the last thing you'd want Molly to call you about and tell you that happened in this series? And I have some options for you, so you're not...
Okay.
I've got 4 options for you to choose from. There may be worse ones, but these are the ones I sort of remember.
Okay.
Would it be the worst for her to call you and tell you about the theme park disaster that's happening in the Philippines? That's where a ride gets stuck, I think, upside down for, I don't know how long it was. It was a long time, I think. Yeah.
Yeah.
And people are stuck upside down. That's A. Option B, is it Molly crashing the opening of the women's shelter? And she treated it like it was, I guess, an Oscars party, very out of touch what was actually going on. There are literally women without homes and in tough situations. She's giving them gift bags and tote bags. Is it C, Molly skipping her media interviews for the foundation, all of which were scheduled, I think, in a single day, or at least in a very close time period, and she's appearing on the show Hot Ones instead, where is the show where you eat chicken wings, very hot. It goes
I remember that.
hotter and hotter, and she's trying to give an interview while eating chicken wings, and of course it leads to kind of a beer fueled. She's washing it down with beer, and she has an on-camera meltdown. And that's option C. And is it option D? This one's going to sound like it's a good thing, and I think it overall is. But again, if you are her attorney, what are you thinking? Option D, Molly giving and announcing to the world that she's giving all of her wealth to charity. If she's giving all of her wealth to charity, is she leaving anything to pay her legal bills with?
Yeah, I wouldn't be too worried about that one, because they don't usually just actually give all their money away. Right. But no, I think the Hot Wings, the interview episode, was the scariest for me as her counsel, or even the foundation's counsel, because so often with these very high profile philanthropists, the media scrutiny, and we talk about that a lot in this practice area. There's what you're allowed to do legally, what's not permitted legally. And then because you can worry about the AG and the IRS and all the penalties that can happen. And those are pretty cut and dried, but not cut and dried, but I mean, they're manageable. You can find answers and you can strategize the best way under the circumstances. But when you're in the court of public opinion, that's a completely different scenario. And there you need your communications director more than your lawyer. So right. I would say that would be pretty tough. So how about you? You get some charitable planning questions and some philanthropists that come into your orbit as well. You'd be looking at it, I think, maybe more from the individual's risk exposure side. Right. Does any of those four actually give you chills to think about? I
think the worst would be, the Hot Ones, the same thing that you had said, because I think it's the least manageable. And because she's washing the chicken wings down with beer, I think she's getting less and less coherent as the interview goes on. I would just be afraid of what she might say, like you said, that would hurt herself or the foundation. I think the theme park disaster, right? I mean, yes, it's bad publicity for her because the world finds out she owns them. But I mean, look, things happen, and it's not like she was the one fixing the roller coaster the day before. I think that's manageable.
Yeah, that's a risk management question, and that's what insurance is for. So That one's, you report the incident and you move on.
Yeah. Yeah, I would just be very afraid of what she might say on that Hot Ones episode, which, like I said, I guess the point too is that she, in the show at least, is the fact that she agreed to it, not sort of foreseeing what might go wrong, was part of, her character. She just went for it.
That's right. So that was definitely very amusing. Also, I'll mention a lot of these specific details about lobbying and candidate activity. We covered a lot of that in a much more dry episode of the EO radio show. And I'll link that episode in our show notes, along with some other useful links on foundation activities. And we'll link to the Apple TV series as well, so that listeners can go find it if they haven't already. So I think this wraps up our first attempt at a review of popular media. Hans, this has been great fun. Hopefully our viewers and you and I and our partners will be on the lookout for more films and series that we can critique this way and use as a teaching tool. I hope the audience has found it both educational and entertaining. Thanks, Hans. We'll do this again sometime.
Absolutely.
Awesome. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource brought to you by the Exempt Organizations Group at Varela, Braun & Martell. If you have suggestions for topics or films you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.